Get to our market panel, Lori Calvasina of RBC Capital Markets and Jake Jolly of BNY Investment Management. Guys, welcome. Lori, so looking at this software move today, names like Adobe, Salesforce, even on the smaller end, Asana, quite a bit higher. It makes me wonder, how vulnerable is this broader market to a moment of AI disillusionment, since AI is so much the story? With, I think you say, the median forward price to earnings ratio of the 10 biggest stocks is near 30.
It is. It recently got as high as, I think, 29.8 times, and it hasn't really been able to break above that 30 times level if you look at recent highs, kind of post-pandemic. So we've got a trade that's generally full in terms of valuations. If you look at the Mag 7 names as kind of a proxy for either the AI trade, or kind of the high-flying mega-cap growth stocks, that one's also seen, tremendous earnings growth if you look back. But if you look forward, you're seeing pretty healthy growth rates, but they're decelerating and losing their advantage relative to the rest of the market. And if there's one thing that I've learned in my 2 decades on Wall Street, when you've got expensive valuations and you've got decelerating growth rates from astronomical levels, it's really, there's just not a lot of margin for error. And I think that's what we're starting to see with some of these reactions.
Well, that being said, still, Jake, you say even if there's no decisively good news coming out soon, the overall market can keep creeping higher if we're just muddling through. Why?
Yeah, I think that's right. I mean, when we look at the macro backdrop, and that's really what my team focuses on, this is still a backdrop that I think is generally supportive for risky assets and equities because, we're going to see moderating growth, but it's going to be positive. We think it's very unlikely to be recessionary. We think that those cuts from the Fed are on the horizon, even if they get pushed off a little bit. And I think maybe most importantly, when we look at the earnings backdrop, the earnings picture, I think, is broadly pretty positive. We are, I think, seeing some of that weakness at the top of the market and some jitteriness coming from that. But when you look at the, other 493, I think there's a lot of positive momentum there. You're seeing, I think, that broadening out in the earnings picture. And I think the sooner we can get to a place where we're not playing sort of the monetary policy guessing game and we can really focus on fundamentals, I think the market will come to appreciate the fact that we still have positive growth. We're going to get some easing on the horizon. And generally, I think that's going to be pretty positive for this market. Now, that might take a few quarters to play out, but I think the setup here is still relatively positive into 2025.
I guess we'll have to see how the fundamentals look by then, a couple quarters from now. Lori, you also say you're not bearish, but you call yourself a tired bull.
A tired bull. And someone used the term aggressively neutral with me recently, and I think that's a great phrase. Look, the reality is it's not just about whether you're growing, right? If you actually look historically at the economy, 0 to 2% GDP, the stock market usually goes down in that kind of environment. The markets don't like sluggish growth. You really need to transcend the 2% GDP environment, kind of getting that 2 to 4% or higher sweet spot to see stocks go up. And I think the problem we've got right now, right, is we've got the squishy consumer. We're hearing, some of that from some of the earnings reports we've had today. The evidence just keeps piling on week after week. And while, I'm not in the recession camp by any stretch, I do think there are a lot of powerful consumer buffers. I do think the consumer is pretty darn mad about inflation and doing something about it. And so we've got to work through that. And if you look at GDP forecasts for next year, they're still sitting at about 1.8%. And if you look at this year, they're sitting at around 2.3. They've actually gone down a little bit recently. We haven't seen them move up. If you go back to February and March when we were having all this excitement in markets, you were seeing a quick ratcheting up of GDP expectations. So, all this sort of squishy consumer labor backdrop easing a little bit, maybe the Fed cuts a little sooner. That all comes against the backdrop of a squishier kind of tailwinds dissipating on the economic front. It's a tough environment for stocks to navigate.
And we're about to find out how Nike did with it. Jake, I want to finish with you and actually ask about bonds. Inflation uncertainty has had them in limbo, you point out. But for people who aren't trying to time the market and get total return, they're really focused on the yield in their portfolios. You think they're going to be mad in 5 years if they locked in here?
I think they're going to be mad if they missed it. This is a very high yield, broadly speaking, market environment for bonds. And, when you think about what we experienced throughout the 2010s, getting to today and, where the 10-year is, it's still a very attractive entry point. Now, I think if you think about the last year, there's been a lot of frustration because everybody said, oh, this is the time to extend, get out the curve, really lock in that duration. And you really haven't gotten a lot of bang for your buck because we've had so much inflation uncertainty. But I think, now the confidence level that we're going to start an easing cycle is just much higher. And even though we're not expecting, an aggressive rates rally in the near term, I think it's still a very attractive entry point for high quality bonds. And when you think about this a couple of years down the road, I think you're going to be happy that you locked that in and built it into your portfolio because, we think about these things in the total portfolio context. And we do think that bonds are going to start to play that ballast in the portfolio that they have historically. That's not to say that, equities aren't going to outperform, but we think that the bonds is really going to provide that stability that it has historically.